Stocks are coming back to life this morning after a rough start to the second quarter early this week, with some economic data causing investors to doubt their rate cut views. Fed Chair Jay Powell reversing some of these jitters after he said on Wednesday that he believes inflation is on a, quote, bumpy path down to 2%, and he expects to lower rates at, quote, some point this year. Lots of meh commentary from Jay Powell there. But with earnings season picking back up next week, could we expect company reports to sway market action once again? Joining us to discuss, we have David Lebovitz, JP Morgan, Asset Management Global Market Strategist and Managing Director. David, thank you for being here. I'm curious with the upcoming restart to earnings season, what you're thinking about what's going to be driving the market more throughout this second quarter here. Is it going to be FedSpeak like Jay Powell repeating the bumpy road commentary, or is it going to be the fundamentals when it comes to earnings season?
So I frankly think it's going to be a little bit of both. And we have the employment report coming out this Friday. We have March inflation coming out next week. I think that's very much going to inform Fed speak and Fed messaging in the very short to medium term. I do think, though, that, given if those numbers are in line with what we've seen more broadly over the past 12 months, so a deviation from the hotter inflation prints and the robust labor prints that we saw in the first 2 months of this year, if that gets us a little bit more back on track from an economic perspective, I do think the Fed will signal that, and I think Fed speak will subsequently take a back seat to the earnings, which, when we think about where equity markets are today, they've gone quite far quite quickly. The majority of the gains have in fact been driven by multiple expansion, and so any further upside here is really going to be a function of earnings, and if the Fed keeps on saying what they've been saying, we think that earnings will start to matter a bit more here.
What does that upside look like, do you think, David?
Well, so I think it depends on the way that the macro story plays out, because if we find ourselves in an environment that looks kind of Goldilocks-y, so pretty solid growth, above trend growth, but inflation that continues to decelerate, the S&P 500 could easily test 5,500. If we see a deceleration in growth and a further disinflation, I think that's going to make upside for the S&P a little bit more challenging. It's important to remember that corporate profits are nominal variables, and so if nominal growth is good, that should help the earnings story. But if we see a slowing in nominal growth, either vis-a-vis softer real activity or further disinflation, that's going to weigh on the profit story, and that's probably going to cap where the benchmark can go.
I wonder, too, what your thoughts are on what we're seeing in terms of movement in bonds with regards to equities. Is the bond market kind of the smarter, older sibling here, and is there a signal happening there that equities need to be listening to, or is it just noise?
So I think that the bond market is the younger sibling that continues to throw tantrums. If you look at implied volatility for the bond market, it's still quite elevated, particularly relative to what we're seeing in equities. And what that really reflects at the end of the day is just this uncertainty, this persistent uncertainty about what's happening with inflation and what that's going to mean for the Federal Reserve. And so if we get a signal on inflation next week that things are kind of back on track, and we hear from the Fed that they are still expecting to ease policy 3 times this year, my view is that will bring bond volatility lower, and bonds will begin to behave a little bit more like they have historically, instead of the kind of twitchy bond market that we've been dealing with for the better part of the past 18 months.
David, what's your base case on cuts?
So I think 2 to 3 cuts this year is reasonable. I think if the data plays out the way the Fed is expecting it to, which again, given their most recent set of forecasts, does not get us to 2% by the end of this year, I think that they will cut rates 3 times. If the data doesn't cooperate, it could end up being more like 2. But I think that this is a Fed that wants to cut rates. They've said that they want to cut rates, and it's really going to take a significant fly in the ointment for them to deviate from that approach.
Let's go with that less likely scenario, though, that you just laid out. If we only get 2 cuts for the remainder or for this year before year end, what's the response, do you think, going to look like in the equity market? Will we see more pressure?
So I don't think that the equity market necessarily cares about when the cuts come. I think that the equity market cares about the fact that the cuts are coming. And so if the Fed signals that, hey, we're going to wait a little bit longer, and that's only going to give us the room to cut policy or ease policy 2 times this year, but we think that we will continue to ease as we move into 2025. I think the equity market will be totally fine with that. I mean, important to recognize that in the most recent summary of economic projections, the way that the Fed was a little bit hawkish was they actually took a rate cut out of their forecast for next year, and that didn't really seem to bother the markets in a significant way. I think the reality here is that 5.25 to 5.5 on Fed funds is indeed restrictive, and what the market wants to see is a Fed that's willing to walk that back a little bit and try to land on a more neutral rate of interest.
David, help us out for non-farm payrolls tomorrow. What do you think is better news for the market, a bigger number or a weaker number in terms of what that does for the Federal Reserve's moves?
So we're focused more on the first derivative as opposed to the headline figures. You know, our expectation is generally aligned with consensus. I think we'll see about 200,000, 215,000 jobs. I think the unemployment rate could indeed edge slightly lower, maybe not all the way back to 3.7, but kind of splitting the difference at 3.8. What we're going to be watching are things like the data on wages, the data on temporary help services, right? Kind of these indicators that give you a better sense of how much pressure is there in the labor market, right? Is wage growth continuing to cool? Is temporary hiring continue to decelerate? That's going to give us a lot of conviction if that's in fact how things play out. That's going to give us a lot of conviction that the labor market is cooling, the path for inflation is in fact lower, and we can continue to expect the Fed to ease policy during the back half of this year. So less focused on the unemployment rate and the payroll figure themselves, more focused on things like wages.
All right, David Lebovitz, great to talk to you here at JP Morgan Asset Management, Managing Director of Global Market Strategist. Thanks so much.
Thank you.